Good afternoon, everyone. I'm Anthony Valeri, Director of Investment Management and Wealth and Fiduciary Services. Thank you for joining us for our mid-year 2024 webinar. For the next 20 minutes, we'll cover the economy and financial markets and then finish with a Q&A session. So let's go ahead and get started into our webinar here. First, we'll start with the economy and talk about the progress and path of the U.S. economy. The preponderance of economic data over the second quarter of 2024 showed a weakening trend. This is the U.S. Economic Surprise Index, which measures the degree to which economic data has either come in above or below consensus forecasts. And a declining line means that economic data has come in weaker than expected. The absolute level doesn't mean as much, rather just the direction to show the progression of a broad swath of economic data. What does that mean? Well, it means that GDP, of the key measure for economic growth in the U.S., is likely to slow. And we saw that in the first quarter with 1.4% real economic growth measured by GDP. And that was certainly a slowdown over the past 6 quarters where economic growth had surprised to the upside rather consistently. The gold bars represent the forecast via the Bloomberg consensus forecast for economic growth on a go-forward basis. And you can see that that path of economic growth is slower than what was witnessed in the prior 6 quarters. So that kind of resurgence in economic growth set to slow. Nothing is expected to be greater than 2%. Now, the consensus may be off, but we do find the consensus a good informed opinion and is often very close to what the growth level will be. So it does show that expectations for the economy are set to slow. Nothing to be alarmed of there. That 1 to 2% GDP growth was often a characteristic of the economy before COVID. So we're getting back to that level of slower economic growth and one to be aware of for investors. That's still a favorable backdrop for investing, but do know the economy is set to slow over the coming quarters. One area where we have seen softening and slowing is in the labor market. The unemployment rate is creeping higher, and at the end of June was 4.1%. That was the 5th consecutive month of an increase. And then we look at monthly job creation, that's slowed from a 3-month moving average of 267,000, that's not shown here, at the end of March, to a 3-month average of 177,000 at the end of June. It is natural to see that level of a slowdown in the labor market. The unemployment rate is creeping higher, something to watch. It just shows that there is some softening, some weakness in the labor market. But as you can see on this chart, unemployment very low on a historical basis and not indicative of a recession around the corner or a substantial change in the labor market. Something to watch, but does show that the labor market is cooling, and this is something that has caught the attention of the Fed and Chairman Powell. Inflation is decelerating, and this has caught the attention of the Fed as well. The overall CPI index decelerated in June down to 3%. That was weaker than expected. In fact, the month-over-month change in the consumer price index was negative for the first time since May 2020. So a substantial change in inflation. To see the first monthly decline in several years is notable. And that even prompted Fed Chairman Powell just a couple of days ago on Monday to say that inflation may be coming closer to their target. We'll have more on the Fed a little bit later. But a fairly substantial change in inflation where the CPI has begun to decelerate again, the core CPI down to 3.3%. And do want to call attention to the light blue or gray bar here, which is shelter. That was a key instigator of this rise in inflation that is coming down, and you can see that it still has a ways to go to get to its pre-pandemic or just around the pandemic average. That means we'll see an additional tailwind to inflation as those rents and housing costs that are embedded in the inflation calculation come down, and we'll likely see continued declines in that category as well. So inflation set to decelerate further. Should note that the next 6 months, the year-over-year comparisons are a bit more challenging, but nonetheless, inflation moving in the right direction. And if we get another decline on a month-to-month basis, closer to the Fed achieving their objective. So this has been a positive for investors as inflation recedes as a risk. And when we're speaking of the Fed, we can't have to also notice that despite their numerous rate hikes, they haven't, it has slowed the economy, but not had the impact that many would have anticipated. Consumers have been very resilient. And one of the ways to measure that is to simply look at household net worth relative to disposable income. And you'll see in 2021 a surge in household net worth relative to disposable income. So even as the Fed has cut rates, as interest rates have gone up, the consumer's been insulated due to rising wealth from financial markets and also the housing market. So the consumer remains in good shape. And this is one way they've been resilient to the pace of Fed rate hikes and why we think the consumer will continue to power the economy going forward and a very low recession risk. Another way to look at that is that the consumer has done a very good job of keeping their interest costs in change. This is a metric from the Federal Reserve. It's the household debt service ratio, which measures consumers' debt service obligations relative to disposable income. You can see on a historic basis, still very low, even if it's come up in recent years. And it just speaks to the effect of how consumers have locked in low interest rates. Let me give you a few examples. 40% of mortgages or homes are owned without a mortgage. That's up from 31% just over 10 years ago. And 60% of homes with a mortgage have a mortgage below 4%. So some stats to show that consumers have done a good job of locking in low interest rates. That's not to say that everyone is immune. We've seen delinquencies go up in terms of credit cards and auto loans, more affecting the lower end consumer, low end income brackets. So there is some things to watch, but for the most part, consumer remains quite healthy and continues to power the economy along. And we're seeing that in consumer spending as well. This is Johnson Redbook same store sales running at just over a 5% annualized rate. Slight slowdown in 2023, but a fairly steady consumption rate. It has slowed a little bit over the second quarter, but even yesterday, we saw stronger than expected retail sales. When you looked under the hood, it still reflects a resilient consumer that would still power along the economy. So we think the 1% to 2% GDP growth is conducive for additional gains in the equity market. Let's shift to a recap of the second quarter. And when we look at investment performance, it was not as great a quarter as you would think just by looking at some of the major indices like the S&P 500. You'll see that in the red box here, there are a number of equity categories: international, the US large cap, when we measure them on an equal weight basis, small caps and mid caps that actually declined during the quarter and saw losses. That's a difference from the leaders, emerging market equities and large cap US stocks, which had a good quarter. So there are vast segments or significant portions of the equity market that actually had a tough second quarter. So a mixed bag in terms of performance, bonds roughly flat. But when you look at the full year, the first half of 2024, generally been a good first half of the year for investors. We've seen gains across the majority of asset classes with the exception of bonds. But you can also see that performance has been concentrated in US large cap equities. They have dominated by a wide margin compared to every other equity category year to date. So that has drawn the attention of investors. We'll talk more about that here. And it is a theme in the markets that's reversed here just in the last week. But important to recognize just how concentrated that performance was. The top 10 stocks accounted in the S&P 500, even within the S&P 500, the top 10 stocks accounted for 74% of that gain. NVIDIA alone, 35% of that 15.3 total return. So a very concentrated market. And if you're an investor, it's tough to keep pace with that unless you're willing to take those concentration risks, which we do not recommend. Now, let's put that into perspective. This is the market cap, S&P 500 market cap index relative to the S&P 500 equal weight. This is the 6-month total return differential. And as a line rising means the S&P 500 market cap is outperforming. Conversely, when the line declines, that means the equal weight is outperforming. And the equal weight is more representative of a diversified portfolio. You can see the surge on the right-hand side of this chart showing that the outperformance of the market cap index was an extreme. In fact, the greatest we've seen since 1999, just ahead of the tech bubble. So notable outperformance from that concentrated S&P index. And when you put it into an annual perspective, the first half of 2024, on the right side of this chart here, shows that the disparity between the S&P 500 market cap and the equal weight almost matched what we saw in 2023, which again was a big year for the market cap index versus the equal weight. Do note on this chart, however, there are multiple years where the equal weight has significantly outperformed the market cap. So it goes both ways. Investors need to be aware of that. And that certainly was a big theme over the first half of 2024. We'll get more into the reversal here over the last few days, but first, what did that lead to? Well, a historically high concentration in the S&P 500 index. The top 10 stocks represent 37% of the index as of the end of June. That's the largest concentration since the 1960s. So that presents risks. Do you want to be concentrated where a single company, if it fails to make its expectations, investor expectations, can lead to volatility and sharp downward performance? So we have to watch that. And again, a risk as we see it going forward. Hasn't been over the last 18 months, but something to certainly watch and be wary of as an investor. That brings me to another topic. There are comparisons being drawn between the current tech-driven market, the AI boom that's fueled some of the technology sector, versus what we saw in the late 90s. And here we show the 5-year cumulative total return, first ending March of 2000, and then for the 5 years ending June of 2024. And you can see we're not even on the same page in terms of total return. That doesn't, not to say that there are expensive sectors of the market. We do think those big 10 companies are expensive here, but they are more profitable. And aside from that, the total return or gain, again, nowhere near what we saw during the tech bubble. So we do not think comparisons to the late 90s are relevant here. Something to be aware of as you continue to follow the financial media. Okay, let's look forward and what can we expect over the second half of 2024? Well, a look back at history, the 2024 is the 14th strongest start to a year. So in the more notable camp in terms of performance from a historical perspective, history would say that the second half would see additional gains. So we are of the view that we'll see modest mid-single-digit gains over the remainder of 2024. We'll get into the fundamentals behind that momentarily. But history shows that generally when you have a strong start to the year, we see additional gains over the remainder of the year. Here we show all of the strong starts to the year. The average performance over the next 6 months, 7.5%. The median is better at 9.7%. That's above the historic returns that you'd see from stocks on a 6-month basis. And then the percentage positive, it's not perfect, 75%. So it suggests a fairly good positive rate, but also additional gains over the second half of the year when you have a strong start to the year. So history would suggest additional gains. We do need to be mindful of valuation. Where does that leave us? Well, we do have expensive valuations in those large companies that have dominated performance year to date. The S&P 500 market cap index sports a forward PE ratio, and we are looking at forward PE ratios here, of almost 22. That's a notable gap versus the rest of the market when we look at the S&P 500 equal weight. But while those companies that lead the market cap index, the Mag 7, et cetera, they are very profitable. They will continue to be profitable, but you are paying a lot for that earnings stability, which we don't know if it's worth that multiple to pay that going forward. So there are some risks, but it's important to note that although the headline index looks expensive on a historical basis, and certainly is, the broader market is much more reasonably valued. So, and that's why we don't expect the equity markets to suddenly capitulate and have a dramatic sell-off. There is much more reasonable valuation in the equal weight index. We've seen a significant rotation over the last week to 10 days as investors recognize that fact, and we think that would continue to play out over the remainder of the year. Important to note that Not all areas of the market reached new highs during the second quarter. Small cap stocks remain below their high from 2021. Here's a segment of the market that hasn't participated nearly as much as the S&P 500. The same is true for mid-cap equities. They're closer to their 2021 high, and not until yesterday did they eclipse that peak. So if there's a silver lining for investors, there is more upside and opportunity in these areas of the market rather than the big cap names that drive the market cap index. And then when you look at global equities, excluding the US, there too, similar situation where we haven't reached a new all-time high quite yet. Again, more favorable valuations here in the market. So there's a strong rotation as investors recognize this to start the third quarter. And it's a reminder of just why you remain invested in. I'm going to take a moment to talk about small caps because this is where it's been most pronounced here in recent days. At the end of June, we had a historic discount between small caps and large cap equities. This chart measures the premium or the valuation premium or discount. You can see that it reached an extreme, 2 standard deviations there at the bottom of the chart, which means you're in the 5% of observation, so historically rare. And again, the biggest disparity since the late 90s. Lo and behold, in the last 5 days, small cap stocks are up over 11%, one of the largest 5-day runs on record. It again speaks to staying invested, staying committed to your investment plan, and why you remain diversified. Kind of similar to the fourth quarter of 2023, where small and mid-cap stocks and even international hadn't participated in the strength of the broader market, but then suddenly did in the final quarter. We're seeing a repeat of that now. And it's important to keep track of these valuations disparities and why you remain diversified, because over time, all segments of the equity markets should rise together. We do keep an eye out on small caps. If the Fed does cut rates, historically, small caps have been more vulnerable. So we're not out of the woods, but certainly this rebound to get more in line to what some of their large cap brethren have done is welcome and a reminder to stay diversified. For the broader market, the catalyst for additional equity gains is earnings growth. And the broader market, when we look at the Magnificent Seven stocks, the sort of equal weight components of the US equity markets, you'll see the gold bars show that earnings growth is set to improve for the companies outside of the Magnificent Seven, and earnings growth for the Magnificent Seven set to slow going forward. As you have that convergence, and I think the market's recognizing that now. Of course, these are estimated forecasts, but we should see better performance or support for the rest of the market, not just those few leaders in the large cap space. So earnings set to improve outside of the Magnificent Seven, get a broader earnings growth, which should support equities for large caps. Usually the equity market turns 1 to 2 quarters ahead of an earnings improvement. So this is coming a bit late given the expectations for third quarter earnings. And we don't fully have second quarter earnings results that just started, but this convergence should help equity investors over the second half. And on a broader note, earnings growth has been very strong. This is what's driven stocks year to date and in 2023. This earnings growth should continue. The consensus for the second quarter is a bit high, so there are some risks here. 10% consensus earnings growth is the highest since 2021. We haven't seen a double-digit expectation. Those are the blue bars since 2021. You can see the gold bars are the actual results, and for several quarters now, we've seen actual results exceed expectations. If there is a single driver we would point you to equity market performance, it is earnings growth, and that 10%, even if not matched, could still be supportive of equities more broadly, but that is a higher hurdle, especially for some of the big tech companies going forward. But we are still having positive earnings growth expected in Q3 and Q4. We'll have bouts of volatility if we don't make this, but again, as long as earnings remain positive, that's a good backdrop for equity investors. Turning to bonds, Treasury yields may have peaked. We have the 10-year and 2-year Treasury yield have not exceeded their 2023 peaks. After a rise earlier here in 2024, they are trending lower. That is 2 reasons for that. Inflation, rather, is on the decline, and the Fed is poised to lower interest rates. Again, Fed Chairman Powell hinted at that on Monday. His commentary before Congress the prior week was also relatively benign. So you have two tailwinds to the Treasury market in terms of higher prices, lower yields, as the Fed's poised to cut and inflation come under control. As we do turn to 2025, however, there is a longer term risk, and that is the fiscal situation of the country. The deficit is still near 7% of GDP, and that comes with employment very low. That doesn't give the government much leeway to provide stimulus, and we should have had a narrower deficit given the strength of the economy. There is still a lot of Treasury issuance coming next year, a lot of refinancing needs. If the country doesn't pursue, and we'll find this out after the election, doesn't pursue a more prudent fiscal path, we could have some upheaval in the bond market. So that is a longer term risk to keep a watch of. But for the meantime, we think bonds offer a much more improved risk reward. I'll talk more about that in a moment. Speaking of bond yields, we're often asked, well, what does it mean for the 10-year Treasury yield or intermediate yield? Will they go lower if the Fed cuts rates? Well, it's important to recognize where the market is expecting or what the market is expecting the Fed to do. And in recent weeks, rate cut expectations have increased quite a bit. Market now expects the Fed to lower the Fed funds rate to 3.5% in 2020 by 2026. A rate cut is fully priced in now for the September meeting. A second rate cut is also priced in before the end of the year, and probabilities are increasing for potentially a third rate cut by the end of the year. I think two is more likely at this stage. We'll likely see more in 2025. But for those of you expecting intermediate rates, the 10-year Treasury has basically baked this into the cake. In other words, the intermediate yields of 5-year and 10-year largely reflect this expectation. So to see those intermediate yields go materially lower, we would need to see a greater drop in inflation or prospects of greater rate cuts. That might require or would likely might need a recession, which we don't want to see, of course. So I think the downside to 10-year Treasury yields a little more limited, although they are trending lower. We think a 3 3/4 level on the 10-year is probably the floor as we stay broadly range bound given the improvement or decline in yields we've seen thus far. Even with that range bound environment, the risk reward for bonds is greatly improved. This chart looks at the 1% or the impact of a 1% rise or fall in interest rates and what it means in total returns over a 1-year horizon. And that's the key, a 1-year horizon. This assumes a parallel shift of the yield curve and no reinvestment of interest income. You can see the blue bars dominate here, meaning that if rates fall 1%, your reward is fairly significant. If rates rise 1%, it's not quite as bad for many of these high-grade sectors, with the exception of potentially the 10 and 30-year. We're not advocating 10 and 30-year securities. We're more intermediate in duration in terms of our positioning for client portfolios. But it does show that the risk reward has improved greatly for bonds. And in the event there is a recession in 2025, I think it's very unlikely for 2024 that bonds would help protect and offer better protection. In the event we have an equity market sell-off and bonds benefit from lower interest rates. One caveat, the two bottom categories there, high yield and leverage loan, there is a credit component there that would affect prices. So take those returns with a grain of salt. We remain focused on high quality bonds to provide diversification to equity investors, and we think equities offer better compelling value compared to high yield bonds currently from an investor standpoint. All right, let's finish up with elections and a reminder that the stock market is not partisan. Here's growth of $10,000 in the Dow Jones Industrial Average, showing that only investing in either Republican or Democratic administrations is not the way to boost performance over time, and that remaining fully invested has been the best outcome for investors time and time again. So a reminder, and we know there are some strong political views out there, but don't let that influence your investments. It's about the economy, Fed policy, interest rates, and inflation that will ultimately, and earnings, that determine your investment success. And then finally, what can you expect in an election year? Well, October and November tend to be volatile. Here we show the VIX index over the calendar cycle, the seasonal chart, and the blue bar represents all years, whereas the gold line represents a presidential election year. And you can see a very discernible trend that in October and November, we do see volatility. It is standard around the election as we get close to it. Ultimately, stock market performance hasn't shown a preference after that, but do be prepared for some volatility. And 2024 is shown at the bottom there, and has been a fairly benign year for volatility as measured by the VIX. Only a pickup in April with the 5.5% pullback in the S&P 500. But again, other than volatility, we wouldn't read into the election and investment results. All right, those are my comments. Thanks everyone for joining. We're going to transition to Q&A.
All right, thank you, Anthony. Always very, very informative. I would like to start with some questions about interest rates. So you talked about rates, but we continue to hear a lot of questions. So I think it's maybe worth addressing again. And the questions are around what is the rate outlook? A little more specifically, what's our expectation for stabilized normal yield on a 10-year treasury? And I think sometimes the treasury comes up because that's probably our best indicator for mortgage rates and where we see those going. And we know a lot of people have either wanting to buy homes or have been holding off, hoping that rates would come down. So could you talk a little bit about our outlook, any ideas, and how investors should think about interest rates?
Yeah, so that is a common question, Rebecca. And as I mentioned during the prepared remarks, a lot of the rate cuts factored in the futures market regarding the Fed is baked into the cake. It's possible they go a little further than what futures are currently pricing in. So that would mean an additional decline. Maybe it's 25 basis points, maybe it's a half a percentage point. But a lot of that's factored in. We tend to view the bond market as range bound here, between a 3 3/4 on the 10-year and say a 4 3/4. That range should categorize rates will fluctuate within that. We think inflation is going to fall further, which provides a tailwind. So a slight drift lower in rates is what we expect. But beyond that, we think that range is fair, just given where we think inflation will level out at, maybe 2.5%. Maybe 3%. There are risks to the fiscal situation, which at that point, inflation with the Fed doesn't matter. That's about investor confidence. That is a risk next year that we're cognizant of, and we don't want to get over aggressive in terms of buying long-term bonds with that risk. But we categorize it more as we're drifting lower in a broader range.
And Anthony, you've mentioned a couple of times that the rate cut expectations are priced in. Could you explain what we mean by that?
Yeah, when we look at rate cut expectations, the futures market basically will price in when and by how much the Fed will lower interest rates. It also works to price in future rate hikes. And so right now, the futures market is expecting the Fed to cut in September and to do one more before the end of the year, and then follow up with 1 percentage point worth of rate cuts in 2025. So that's a lot. You have to recognize the market is always a forward-looking mechanism and tries to factor that in ahead of time. It's when those expectations change that you see a corresponding change in the markets.
Okay. The next questions are really, I think, more around geopolitical risk and questions such as what would happen to my retirement savings in the case of a war, but then also the potential for significant supply chain disruption caused by aggression or other types of circumstances. And one thing I think is interesting, we actually just not too long ago had a significant supply chain disruption with the COVID-19 pandemic. So I think we actually have some recent history that gives us a little context for this. But when someone's thinking about the geopolitical risk, how do we help frame that in terms of like a longer term plan?
Yeah, we do. We get that question, and there's been no shortage of geopolitical events over the years, over the decades. The data consistently shows that outside of the near term, say 1 to 2 months, that the impact is pretty limited. So yes, those geopolitical events do have a negative impact. We've often seen a decline in the equity market. Maybe it's 3%, maybe it's 7% over the coming month or 2 months. But beyond that, once you get to 3, 6 months, 12 months out, there is no impact. In fact, the stock market goes back to fundamental data like the path of the economy, like earnings growth. So historically, it's been fairly consistent. We have not seen geopolitical events be a driver. And that's been, again, the case here. It was most recently, again, the case with the Russia-Ukraine war. And regarding supply chains, the terrorist activity in the Suez Canal has rerouted some traffic around South Africa. That's only about 10% of trade. It's a small number, and been fairly manageable. So we don't see any trade disruptions. Of course, that could change. But from a geopolitical perspective, it's usually just a short-term impact and pays to stay invested.
Okay, great. Shifting to the economy, you talked about the employment rate and job creation rates are unemployment rate and job creation rates are slowing. But at the same time, we have a very resilient consumer. Consumer spending remains strong. The question here is when will we get back to an unemployment being a bad indicator for the stock market?
Yeah, it was good. That question revolves mainly around looking at weekly jobless claims, which I didn't refer to in the presentation, but weekly jobless claims still very low, hovering around 225,000. You would need to see a material increase from there up and over 250,000 and stay there, get closer to 300,000 for the job market to really send a sort of a warning signal that would be interpreted negatively. The population is growing at a slower rate, such that even job gains of 50,000 to 100,000 a month is enough to sustain the labor force. So that might be interpreted in weak. It's not. I think it's weekly jobless claims where you'll see that data first. And of course, if the unemployment rate were to go to 4.5 and continue this upward trend, that would be worrisome. I still think we're a ways away from seeing that, but I would point investors towards weekly claims as the first sign of trouble if we're going to get it.
Great. And maybe along those lines, there is a question that's come in about the Fed's 2% interest inflation target, and basically saying, is that a kind of outmoded target in today's economy? Should it be higher?
There's a lot of debate at the Fed whether that should be higher. I think Fed officials continue to debate that. There has been discussions about raising that to 2.5%, but for now, they're holding to 2%. The recent CPI report that covered June, the core rate actually was 2.1%. When you look at just the last 3 months and annualize it, that's pretty close to the Fed target. If you look at their favorite measure, core PCE, that's at 2.7 on a 3-month annualized basis and coming down. So those measures are getting close to the Fed's target. I think that's what Fed Chair Powell was alluding to when he said on Monday that inflation is coming under control. So we're getting close to that level. We think it's probably settles out a little higher to that, but it's not too far off of their 2% target.
Great. Let's shift to investing. And I think you did a nice job talking about we saw performance really dominated by US large cap stocks. And I think that there's a temptation now, the feeling diversification doesn't work, the feeling even within large cap, diversification may not be giving you the same results that you're seeing in the press. So, how do we get someone to avoid the temptation of focusing on large cap when they feel like all of the other pieces really haven't been beneficial in recent years?
Yeah, I think that's a tough one. We get that a lot. It's easy to chase performance. Large cap versus small, when you look longer term, going back decades, their performance is pretty even, maybe a slight edge to large cap, but it's fairly small. And it's just being aware of what you're paying in terms of valuations. And when you have a big gap, like I showed with small caps, that's a reminder to stay invested. Those are rare opportunities. They're tough to live through, but know that we have those extreme valuations, they revert. Big companies should be the focal point of your portfolio. They aren't ours. They should dominate the equity exposure. That's your most stable and best growth of earnings growth and equity performance. But it does make sense to diversify. And speaking of diversification, that can go in multi-year runs where it works or doesn't work. 2000 to 2008 saw diversification work and work well. And then since in that post financial crisis period through 2012, it was mixed, but mostly didn't work. And then, of course, the last 6 years, it's been it hasn't worked. And it's been the large cap markets that have dominated. When you get these big weights, there is risk to a single company underperforming. And so I still think diversification pays over time. Yes, there'll be times you're disappointed, but over the long run, that's your best bet for achieving your goals and not having the wild ups and downs that a concentrated portfolio would have.
And Anthony, I think that's a really important point. When we talk about investing, you need to have a long-term view. And we're not talking about the history of all time, but your view needs to be more than just even what's happened in the last 5 years, what you think will happen in the next 5. We've talked about the benefits, how consumers have benefited from low rates and the number of people who have very low interest rates. We've seen an increase in wealth. And then this question is saying, really, when is the best time to invest money? And a little more with the economy the way it is it possible to invest and make money? I think a couple of interesting points here is one, how we think about market timing, so that best time, but then also in the perspective of had you not been invested the last few years, what does that look like?
Yeah, I think another popular one. Anytime is a good time to invest, especially if you're going to be diversified. Timing doesn't work, it leads to disappointment. And every time you fail to invest and the market goes higher, it's just harder and harder to make up that gap. Hopefully in the presentation show that there are areas of the market that are not overvalued or at least fairly valued. Yes, there is a swath of large cap stocks that are very expensive, but for investors who do have money to put to work, come up with an investment plan, know what you're investing for in the future, know your risk tolerance so you know how much to put between bonds and stocks. It is a much better time to invest in bonds now than it was just a few years ago. Be thankful you missed the worst bond bear market ever. And so interest rates will help you out there. And then on the equity market, there are segments that haven't fully benefited and offer more opportunity than just the big cap names. And I would say take a gradual approach, do a dollar cost average to lessen the risk that you're getting in at the wrong time. But do get started time and time again. We've shown if you stay committed over 10, 20 years, 30 years, you will be rewarded. So I think it's any time is a good time to get started. And time in the market is more important than timing the market.
And I think along that same line, we have a question that's come in that what percentage would you recommend in cash? And does that percentage change if you think about markets, up markets compared to down?
Yeah, we don't. We do say invest if you're going to invest. Cash has rarely outperformed a diversified portfolio. It's appealing now with 5% rates. I understand that it did do better than bonds recently in the last few years, but that's changing. And by the time those short-term cash rates and there are a change, which is coming, it's coming later this year. It is often too late to take advantage of the opportunities in the markets. So from an annual perspective, I think it's twice in the last 40 where cash has been the top performing investment on an annualized basis. So it generally does not win, and you're better off with a diversified portfolio.
And Anthony, I think along those same lines, we always encourage that everyone takes a planning approach. So cash is your emergency fund. Cash is what you need to buffer a downturn. I think about it very separate from your investment portfolio, and playing with cash in a portfolio is very, very similar to timing equities, timing bonds, everything else. So I encourage people, know what your plan is, know what you can invest. And it's critical if you need the cash, I would keep it in an outside vehicle, use a bank vehicle, something that can maximize your return, but with a kind of safer return. And then when you think about your investable assets, those need to be assets that can ride out a few market cycles in your portfolio. Another question that's come in is just really around like, what do you think the biggest threat to equities is in the next 12 months? I think kind of related is we think about, we have this basis for earnings growth exceeding 10%, but really the last few quarters have been closer to 2 if we take the Magnificent Seven out. So where do we think the biggest risk to equities is? And do we see a correction coming? And kind of does that change anything we've said, previously today?
Yeah, 5% pullbacks are a normal part of the market. We had one in April. We will likely have another. We might have a 10% correction. The big 20% type bear market, that happens every 4 years or so, and is usually accompanied by a recession. Very rare to have a non-recessionary bear market. With that said, we had one in 2022. So it does happen. It's not, certainly not a black and white type of scenario, but absent a recession, we don't see the big drawback, but the 5% declines, those happen regularly. The average intra-year decline for the stock market is 14%. It goes all the way back to 1980. That's been fairly consistent. So it is just the nature of the equity market that short-term emotions can overpower fundamentals and you get those corrections. So if you're an investor, be prepared for a 10% correction, which happens almost annually and sometimes often worse than that, 14. But have a plan, be diversified. And when we talk about risks, Rebecca, that I often get asked that question. The real risks are the ones you don't see. September 11 is one. The Enron accounting scandals is another. COVID, another example. It's those risks you don't see that really end up pummeling the market because the others are known to some degree and markets react in advance of that, either to provide a premium pricing or discount pricing. So there are plenty of risks over time. There are plenty of shocks to the market over time, but in general, diversified portfolio is still grown throughout those cases. In terms of the near-term ones, I would say a recession or a severe earnings decline would be one. I don't see that happening over the rest of this year. And then the fiscal situation is a risk as we go into 2025. Those are visible, however. But beyond that, again, I just remind people that the biggest risks are the ones you don't see.
Yeah, Anthony, I think that's really helpful. And I think one of the things we like to encourage investors to do is we talk about volatility and percentages, obviously. So you saw the volatility index and you think, okay, a 10% pullback. Also think it's important if you have $1 million portfolio, just keep in mind that's $100,000. So as you think about it, putting some numbers to it and knowing that's volatility and that can happen, I think helps also keep you from pulling the trigger at the wrong time and making decisions based on emotion rather than sort of the fundamentals for your portfolio. All right, a final question here. And this is a great one. The crystal ball. Any estimate on future tax rates? So I'll jump in and say there's starting to see a lot of popular press around this. The Tax Cut and Jobs Act was a temporary tax act that is set to expire. So from an income tax rate perspective, we currently see certain marginal rate decreases going away at the end of 2025. And then really starting in 2026, without congressional action, all of the rates will return, all the individual rates will return to kind of the pre-TCJA rates. So those will go up, but there are also some deductions that will change as well. So that's what's set to happen. When we think about estate taxes, and this is a much bigger one, if you have a taxable estate, right now, after 12/31/25, the federal estate tax exemption will revert back to it's 5.6 million per person, adjusted for inflation. That number is almost 3 times that size right now. So if you are someone with a taxable estate, I would really, really encourage you to get in contact with us and speak with a planner and talk about some of the things that you can do, knowing that that rate cut potential is coming and is coming quickly. I think when I think about the others, while I think it's always important to be aware of taxes, it's also that we invest first and then we manage for taxes. So we think about taxes in light of investing. I think if you put taxes first, it's not a great strategy. It's more important that we put your strategy first, understand the tax situation, and then think about that. There's a lot of proactive planning you can do if you can time certain deductions, if you can time income, knowing that the rates are likely to go up. And we don't know where we will end up politically, so we don't know the likelihood of that act being extended, a new one going in. So kind of keeping that in mind. And Anthony, anything else you would add to that?
No, I think you hit it on the head. I would just stress again, don't let taxes be the tail that wags the dog. It's something we keep in mind, but investing via taxes is not a way to success.
Great. Well, that comes to the end of the questions. We want to thank everyone for sending them in and for joining. And for all of you who have registered, you will receive a follow-up email with a link to this presentation as well. And as always, if you need help, we are here to do that. So contact information, if you'd like a wealth advisor to reach out to you, please let us know. And we look forward to seeing you in a few months.